on the PMS industry over next 10 years, how will it evolve? Because of late, what we have seen, there are many mutual fund investors in the HNI space who. So today we have amongst us Mr. Ashish Somaiya, who is the Managing Director with Motilal Asset Management. Welcome, Ashish.
Thank you.
I have one question in first to begin with. So Motilal Oswal, has contributed a lot in creating the culture of long-term investments and doing wealth creation for investors. And their philosophy of buy right, sit tight over years, has kind of helped educate also investors to become long-term in their approach.
Yeah.
So, what is your opinion? How good is this strategy for say next 10 years, given the changing environment, markets are getting volatile? So, over to you, regarding this.
See, I think that as far as the equity market is concerned, or like you said, creating wealth in the equity markets is concerned, clearly there is no one way or there is no one right way of doing it. Right? There are multiple ways of participating in the market, and like I said, there's no right or wrong. But what is important is that you should have your strategy for you to be able to participate effectively. So when we put forth a particular investment strategy, like say buy right, sit tight, and we clearly say that buying right means basically we are buying companies which are high quality, high growth, low turnover, and we're looking to hold each company for say 5-7 year kind of time horizons. So till the time the growth phase of the company lasts, we would like to participate in the entire journey. Now that is actually our belief that this is how wealth is created. So when we are out there to manage public money, outcomes are uncertain because equity markets, nobody can predict the market or the share prices. So what I find is that for any kind of science or any kind of approach where the outcomes are uncertain, they are probabilistic in nature, the only thing you can control is the consistency and quality of inputs. So having a philosophy, having a defined set of do's and don'ts, I think that is something which can give people a clearer sense that how is it that these guys are planning to conduct themselves in the market. So like I said at the beginning, there's no right or wrong, but having a philosophy is something which is extremely important. And my sense is that you asked specifically that how is it poised for the next 5 to 10 years. I think what is important is that we have been practicing this philosophy for the last 16 years. And over the number of years, through series of wealth creation studies, through our live experience of managing money, obviously the philosophy gets refined over a period of time. So I think it's a continuous process, but I'm sure it will hold us in good stead.
Sure. So it is also reflected in your long-term performance. So
Sure.
We cover all the PMSs,
Of course.
and Motilal Oswal pioneered the PMS industry in India.
Yes.
And if we see last 5-year numbers, so Motilal Oswal next $1 trillion opportunities appears on in top 3.
In the top, yeah.
So buy right, sit tight has worked in long term.
Yeah.
So that's right. So what is your opinion on the PMS industry over next 10 years? How will it evolve? Because of late, what we have seen, there are many mutual fund investors in the HNI space who are looking forward to the customized demat account and holdings, the way PMS operates versus mutual funds. But at the same time, the PMS space is relatively less regulated versus mutual funds, right? So with regards to this evolution, how do you see this evolution going? And
So there are a few differences. I think that what is the difference between a PMS and a mutual fund is not very well understood, right? Like why is it that we are in the profession of offering PMS services when actually there are enough and more mutual funds that are available? I think there are, and when it comes to mutual funds or when it comes to equity investing in general, it is very well understood that one of the key determinants of the outcome that an investor will get is not just equity as an asset class. It's not just the skill of the fund manager. It's also the behavior, right? I mean, that, like I said, we like to buy great companies and hold on for 5 to 7 years, but in that there'll be 1 or 2 bad quarters where those great companies will not do well. And then you need to have the psychological strength to tide over that period and ensure that your conviction doesn't get shaken up. Now this manifests very strongly in a mutual fund. If I give you current example, In December 2017, the entire equity mutual fund industry had a positive net flow of 27,000 crores. That was the highest ever number in a single month. In April 2019, I'm seeing that the net flow is struggling to be around say 2,000 crores. What it tells me is that on an aggregate, mutual fund investors were buyers in December 2017, and on an aggregate, a lot of them were actually sellers in April 2019. Now look at it this way, in a mutual fund you are investing as part of the pool. You may be a long-term investor, but somebody comes after you came and they exit well before you exited. Right? Because of people voting with their feet, the fund management activity in a mutual fund involves not only stock picking, but it involves a lot of fund flow management and reacting to the people coming in and going out. In the last 5 years, the mutual fund industry corpus has gone from 150,000 crores right up to 900,000 crores. So 2 years back, which fund you bought, what did you see in it, why did you buy it, versus what it looks like now, how many investors it has, how many are coming and going, what kind of turnover it is causing, a different story altogether. Now see, as opposed to this, how does a PMS work? You give me money today, I have a notion of what are my best ideas, I deploy and credit stocks to your demat account. After that, a million people can come and a million people can go, you have nothing to do with it because your balance is lying in your demat account. And if market tanks like October 2018, some people might be panicking and withdrawing, whereas you might be the smart cookie who chooses to actually top up on your investment. So for people who go out, it's their demat balance which is sold and money is paid to them, and people who top up, so the worth of those shares gets credited to their account. So what a PMS does, in mutual funds also there is a fund manager who does stock picking. In PMS also there is a fund manager who does stock picking. But what is the difference in the operating configuration? That in a PMS, the behavior of individuals is isolated from one another. Whereas in a mutual fund, the sum total behavior of all the people impacts the remaining investors. I think that is different. Apart from that, there are a couple of differences which are glaring, but I don't think people pay much attention to it, which is that if you invest in an equity fund, there are strong definitions of what is large cap, what is mid cap, what you can buy, what you cannot buy, what is your benchmark. You can't have more than 10% in a stock and so many things. Whereas in a PMS, we buy a mid cap in the hope that eventually some of those will become large caps. If you're not going to let me hold a stock beyond 10%, and if you're going to not let me hold a stock which crosses the investment universe, then sometimes the purpose gets defeated. So I have no favorites, but I think since we manage both with equal passion, it's at least our duty to bring out the differences. And netted, I would say that if you're a well-convinced equity investor who likes the fund manager, likes the stocks, and wants to hold them for a longer period, in that case, I think PMS is a better platform. Of course, it may have more volatility and more risk associated with it. But in terms of return potential, I think the platform has the ability to deliver more.
Right. So, you represent the largest and the oldest PMS in the industry. And I agree with you that mutual funds are prone to behavioral flows.
Yeah, they are mass retail vehicles, so other people's behavior will impact.
Right. And as more and more retail investors are coming in mutual funds, obviously these vagaries of behavioral flows, which rise in rising markets and fall in falling markets, have an impact on decisions. Yes. Fund managers, decisions.
Yeah, because it's seen that people are buyers in the peak and they are sellers at the bottom. So you have to isolate behaviors.
Right. So coming back to the second part of my question, that in case of a mutual fund, there is a standardized method of disclosing NAV.
Sure.
Right, but in case of a PMS, right, there are certain PMSs that follow aggregate, model. Some PMSs follow model portfolio. Some PMSs follow, just universe of stocks. So there is no standardized methodology of representing the data. So that is where maybe industry has to evolve. There is a AMFI as a body which represents and takes care of the standardization of and maybe the publication of data, right, in case of mutual funds. If PMS industry has to evolve, in future, obviously, these developments have to happen. And so what are your views, with this regard?
See, first thing I think is that the methodologies are not standardized because people actually practically have different ways of managing money. Look, there are some people who say that every client who gives me money, I create a different portfolio. What is the reason for creating a different portfolio? Because there is a notion that, okay, some stocks have already run up, some stocks are relatively cheaper. So if you come today, I buy this kind of portfolio. If you come 7 days later, then the stocks which have run up, I may not buy, and all those kind of things. Now that kind of logic may be relevant for people who are investing or holding certain positions with a 1 or 2 year view. So for them, every 2, 3, 4, 5% movement in stock price, they really want to pay attention to those kind of variations. And hence, for 100 different clients, they might end up having 30, 40 different types of portfolios. And hence, they might be thinking that they should give you an aggregate number or an average of all clients or something like that.
Sure.
At our end, we follow a model portfolio. Because we believe that if a stock has run up and if we have to sell, we'll sell for all clients. Why only the guy who's coming new, we should buy less, and the old client, we should hold more, and all that logic doesn't apply.
Right.
Because when we rebalance the portfolio, so every morning, according to us, every morning the portfolio that we have is our best ideas portfolio.
Right.
And for us, all the clients, unless they give us specific instructions, unless the client has given a request for customization, we align everybody's portfolio to a model portfolio. So we believe in reporting the model portfolio, knowing fully well that in our case, for all the clients, the return will be model portfolio plus or minus few basis points.
Right.
So we are comfortable reporting the model portfolio because we know that the variance is brought down to a minimum, and we can do that because on an average we hold a stock for 4 or 5 years.
Right.
So what will I achieve by giving you a different portfolio 7 days later,
Right,
and somebody else a different portfolio 15 days later? I won't achieve too much because my average holding period for a stock is more than 5 years.
True.
In fact, if you open our PMS documentation, the first page is something called a PMS Charter, where we are clearly telling people that we are looking to hold for 5 years plus, and you are also expected to remain there for 5 years plus. So we don't see merit in creating multiple portfolios and aggregating the returns.
Right.
And in fact, if you create multiple portfolios and then report and aggregate, still the best and the worst and the first and the last will deviate significantly. Whereas if you align everybody to a model and report the model, with my experience, I mean, I have been running it in this company for 7 years and totally in my career for 19 years.
Right.
I have seen that if you actually have the practice of aligning it to a model, then people will be few basis points deviation. So I think that the differences are coming because of different practices, and unfortunately, like a mutual fund, this is not managed as a pool, so it's difficult to align those practices. But I do agree with your point that maybe the industry needs to have an industry body, because it's not just about reporting performance. There are many other things which can be standardized.
Right.
All said and done, nobody should expect that a PMS will be as standardized as a mutual fund, because then it will become a mutual fund. Then there is no point.
True.
Right? So we need to preserve the purity of the concept also.
Right. Now, over a period of time, as the culture of equity investing is growing in India, as there are more and more affluent investors who are increasing in our country, there are many star fund managers who are opting out and starting their boutique PMSs.
Yeah, of course, yeah.
And more than this, the recent categorization of mutual funds, right? That also restricts mutual funds.
Yeah, the latitude.
In their latitude. And because of that also, there are some of the fund managers who have taken a PMS route.
Sure.
Also, there are a lot of young, I would say, research guys right, who can today opt for a PMS route by just taking a license. It just costs 5 lakh rupees. So it has led to multiple PMSs. More than if there are 44 or 45 asset management companies, there are more than 60-70 PMSs.
Yeah, there are more actually.
Right, there are absolutely more. Right. So from the perspective of an investor, when he has to choose between an institutional PMS like Motilal or ASK or a boutique PMS, right? There are many there. So what are the 3 or 4 points that an aspirant equity investor should look for while selecting amongst the entire bouquet of products?
See, first is actually, frankly, I don't think getting a PMS license is that easy, because it needs minimum net worth to be maintained at all points in time, and last I saw the minimum net worth maintenance was 2 crore. And obviously you need to be a well-set organization with compliance officers and the systems and the processes and dealing operations and of course investment management capability, and more importantly intensive customer service kind of systems.
Sure.
Right. Plus you need very strong auditors, because you are supposed to audit the client's accounts and provided them audited statements, etc.
Sure.
So a lot of these things are important. So I think boutique or institution, I think, is a very good question that you asked. But all said and done, some kind of organizational setup is absolutely required. I don't think it is functioning, and I don't think it can ever function like a small business or a cottage industry kind of thing. It needs a setup. It needs a lot of investment as well as capability. But that apart, I definitely like the question on whether it should be institutional or boutique. So while we have a big brand name, but actually we ourselves treat or see ourselves as a boutique. Because we are overall, if you see the house, whether it's mutual fund or PMS, we are only equity. Within equity, we are a single philosophy company. So we don't do growth and value and cyclical, contrarian, blah blah blah. We have only one type of thought process. We bucket it by large cap, mid cap, and multi cap, but basically we buy quality companies and hold for 5 years. That's the thought process, right? So we identify ourselves more closely with a boutique because we don't do fixed income, we don't do multiple types of products. We slot our products very in a proper niche. I feel that boutique, so that's what my clarification about us is, but I don't have any preferences of boutique or institution for a simple reason that in this what matters is that, what is the skill or passion of the portfolio manager, how good is the portfolio manager, what is the track record. Second is, do they have a well-defined process or not? It's more important to have a process in PMS than in mutual fund because in mutual fund, the regulation straitjackets you. Whereas in the PMS, like you rightly pointed out somewhere, the latitude is so much that it's better that you have a written down, defined field that, okay, this is where we will operate, this is to be done, this is not to be done. So I think that the experience, the strength of the processes, I think those things are extremely important. Now, very simple point, a lot of people had launched PMSs, but they were trading and churning. The simple thing is that when you manage a PMS, you have to be extremely conscious about the tax implications of your clients. So that's a nuance that one must keep in mind. The second thing, for example, we had this discussion about model portfolios. Now, everybody who comes new in the profession, they say that I will create different portfolios for different clients. Now, with 16 years experience, I can tell you that no, it's not practical. Tomorrow, you say that you create different portfolios, and Kamal comes and says that I got 1% more return, and somebody else comes and says, I invested just 2 days later, I got 3% less return. How are you going to explain that? Are you assuming that you will always be a small player, or are you going to prepare by putting the systems and processes in place? So I know that there are certain, with a lot of experience of running for so many years, we understand what kind of setups are required, what processes are required. When you are a small business, some things are possible, but when you become slightly larger, all those things are not to be conducted in that manner. So I'm pretty sure that there are very bright people who can perform very, very well, but I don't think it can go beyond a point without a organizational setup.
Right. Now coming on to the the evolution thing again, right? In case of mutual funds, earlier there used to be entry loads,
Sure.
and fund management charges. Now entry loads are not there,
Of course,
right?
yeah.
In case of PMS, still there are certain counters who would charge entry loads, right? But eventually the investor is becoming informed that the entry load need not be charged because there is a fund management charge already.
Sure. Yeah.
So what are your thoughts regarding this?
No, see, look, in a PMS there are various flexibilities that are there, right? What kind of entry load or what the people call setup fee or what kind of exit load. I want to clarify a couple of things because a lot of times there are questions on the fees on a PMS and the commercials. Now I run a equally large mutual fund, equally large or equally small, whichever you look at it. Our corpus in the mutual fund and PMS is almost the same. But our weighted average TER on our PMS is lower than the weighted average TER on the mutual fund. That's the first point.
Okay.
So depending on the size of the application that people make, obviously in a PMS there is the ability to calibrate the expense ratio. So if you put a sum total of all costs, then I think there is a way to calibrate the expense in a PMS also. It doesn't need to be high.
Right.
Second thing, of course, in PMS, a lot of people come with a variable fee structure. And in my understanding, if you're a long-term investor who understands that there will be many years when the return will be more than 15-20%, then you may not go for a variable fee. But if you are somebody who thinks that no, the manager should earn when I earn, then you'll go for a variable fee. But anyway, your question is more on the setup fees, and I think that clients should be aware they should not pay it actually.
Right.
Because let's say if you invest for 5 years, somebody gives you a reduction of fee somewhere else, but they charge you a setup fee. So in 5 years, it will add up to 30-40 paisa per year.
Right.
But if you end up remaining shorter,
right,
then it's going to be a very expensive affair. So I think people should look at fees, all components in totality, number one. And number two, I think, this setup fee, of course, my sense is it will not remain for long. I think the industry will align and ensure it is out. But even if people who, people should get into the details and they should avoid paying high fees.
Right. Thank you so much. Last thing, it's your favorite topic in your words. we would like to understand the meaning of Q.G.L.P. It is, the stock picking philosophy adopted by Motilal. It's worked very well.
Yeah.
Right. So,
See, actually, what we do goes with this acronym. When you say buy right, then obviously it's incumbent us upon to explain what do you mean by buy right. Because when you say buy right, sit tight, it sounds like a smart mantra. A lot of people think it was stated by Warren Buffett, but actually no, it was written by a Wall Street trader called Jesse Livermore way back in 1923. So we adopted that. But when you say buy right, sit tight, a lot of people sit tight in the markets. And on a lighter note, my observation is that when people buy right, they book profits. And when they go wrong, they actually become long-term investors, that is, they sit tight. So actually, because of that experience, obviously it's incumbent on us to explain what buy right means. And in our understanding, buy right, we coined this acronym, which is Q.G.L.P. So quality, growth, longevity, bought at a reasonable price. So quality, growth and longevity are the attributes that we look for in a stock or more importantly, in a company. But instead of getting into the English behind this acronym, I think I would spend a couple of minutes to explain to you how it plays actually in the market. In the market, that people look at market caps and valuations. So just to put it simply, a company whose EPS is 10 rupees, it quotes in the market, if you take Nifty PE at 29 times, it means on an average company whose EPS is 10 rupees in March 2019, that should be quoting at 290 rupees in terms of its market cap. Now, at 290 rupees for a 10 rupee EPS, there are people who are buyers and there are people who are sellers. So the seller thinks it's expensive at 290, the buyer thinks that even if I buy at 290, I will still make money. Now how, and none of these guys are wrong, actually both are right. But what happens in the market is that the guy who's selling at 290, he might be thinking that the growth prospects for this 10 rupee EPS, the growth prospect must be something like, it will grow at 15% for the next couple of years, and then it will taper down to 10%. So it doesn't look great. Now let us say I'm the buyer, and my hypothesis is that no, this will grow at 15% for the next 3 years. And after that also it will continue to grow at 12-13% for the foreseeable future. So what is expensive for you at 290 might be reasonable for me at 290. And that begs the question that what does the market pay these multiples or the market cap? What does the market pay for? So market pays for three things. One, the market pays higher multiples to companies with higher rate of growth. So market pays multiples for rate of growth. The second thing which is evident in my description is that the market pays multiples for the length or sustainability of growth. So the vertical dimension is the rate of growth and there is a horizontal dimension which is the length of growth. And the third thing that the market pays for is that companies whose growth fluctuates less, they get richer valuations than companies whose growth rate fluctuates a lot more. So market pays for rate of growth, length of growth and low fluctuation of growth. And from there all these numbers come. That what is my growth hypothesis? What is this the business moated or not? Where does fluctuation come from? Is it a secular business or a cyclical business? So you see, we don't buy cyclicals and commodities. We don't buy leveraged companies. Then sustainability comes from good ROEs, good the growth in the category, the leadership position of the company. Are they able to protect their margins over the long term? Are they a discount seller or a premium seller? So there are many things which translate into arithmetic, but I've tried to explain in a simple terms that what does the market pay for, and we would like to have those things in our portfolios.
Sure. Thank you so much. It has been a pleasure talking to you.
Thank you.